Welcome to the daily update, where I'll go over the action in the market for Wednesday, June 12th, and then we'll see how things look for Thursday, June 13th. Well, it was a highly anticipated day. We certainly had a lot of news hitting the markets. We had CPI come out, and there was positive reaction to that. We gapped quite a bit higher right at the open, drifted sideways. Things settled down a little bit while still maintaining the gains. And then the Fed came out, made their announcement. Jerome Powell made his speech, and we were still able to hold on to the majority of the gains. We did close well off the high. When we look at the bar for today, that could potentially look a little bit scary, especially if we see some kind of a move down from here. We're going to get PPI in Thursday's session, as well as jobless claims. Those can be rather influential as we get them every week. But for right now, we're looking positive. We are overextended or showing good momentum in the short term. We're still seeing negative divergences. They're not getting taken care of. One of the things that I've been pointing out is as these negative divergences have been developing and areas of weakness that we've been seeing, is that a good solid update could take care of that. Well, that didn't happen in Wednesday's session. We're going to need to see more follow through. We saw an improvement and we're seeing growth improving compared to value, but now we need to see more follow through as we go through this. Please know that the SPX Investing Program has launched. There's a lot of additional things that I'm doing, and I'll be doing even more beyond the video that you're watching right now. Also, one of the things that you get as a member is first access to the daily videos. Otherwise, when this video is done, I set a timer on it to become public right when the market closes. For some of you, that's fine, and you don't mind watching this after the market closes. These videos are designed to be viewed before the market even opens, just to give us a good plan for that particular day. If you want to talk to me about this, there's an email address right here. There are links in the description below this video that will tell you more about the program, and it'll also take you to the SPX Investing Program site. For the month of June, everything is free. That's probably going to change in July, but for now, you can just go check it out. It'll just require an email address. If you end up not liking it, you can just unsubscribe, and that'll be that. One thing I do want to mention, there is a person that I follow. His name is Bob Kendall, and he comes up with the Kendall Report. Some of you may be familiar with him. He posts videos on YouTube. He's been around a long time. He has even more experience in the markets than I do. And he also posts a daily newsletter. And he has some interesting indicators, technical analysis indicators that he's developed over the years. And I made a post about this, and I went into more detail on the SPX Investing website. But he posted a video yesterday, and I'm going to put a description to that video below this video in the description area, where he's seeing some things that could potentially be not good. Now, we don't know if this is actually going to happen, but when he takes some of his indicators and puts them on CPI, building permits, the Fed funds rate, they're predicting, and I'm not a big predictor. I think it's pretty much a fool's errand to try to do that. I just believe in evaluating things where they're at right now, and then what is the probability for the next day, and then reevaluate things and look forward. When you go out 6 months or a year, to me, that's useless. But a lot of people love that kind of stuff. Well, his indicators, and we don't know if they're going to actually show something like this, they're predicting that interest rates near the end of 2024, possibly into 2025, are going to get sent back down to zero, similar to what we saw during the COVID crash. Now, we don't know if something like that's going to play out. I do know that lately he's been pretty bullish on the economy. He really likes AI. He thinks that's really going to help GDP. That's where a lot of the growth is going to come in the future. But then he comes out with this report showing that when he looks at some economic indicators and interest rates, because usually he does an analysis of the S&P and the NASDAQ 100, and that's what I follow. Well, he took those same things and put them on the Fed funds and interest rates, as I said, and they're all predicting things going down, not necessarily right now, but maybe 6 to 8 months out in the future. For something like that to happen may require some kind of a bad event. There may be a reason that the Fed is going to have to do that, like a war or some kind of a black swan event. Now, we don't know, and this could always change. And so it's not necessarily to scare you, but I would take the time to watch the video that he posted and just tuck it away as information. That's what I do with these things. It's like, okay, I'll let the charts tell me what's actually going on, but I like his insight, and he's not a perma bear. He has been quite bullish on the markets. And then he said he struggled with putting this together because this is kind of going against the scenario that he has developed for the market. When we're up, he's more positive. When we're down, he's more negative. And his videos are freely available on YouTube. You might want to consider his newsletter. I think it's $8 a month to get that. And I do subscribe to that. So feel free to check that out and just make it part of your knowledge background. And then we'll just see how things go from here. All right, let's go back and talk about what happened. Right at the open, we had a gap higher open above R2. We got above the 5,400 level. So R2 was at 5,408. We kept trying to go up, but prices didn't even get up to 5,450. I was watching that thinking, okay, this is a nice round number. Maybe the market will go up to that level, and that will be resistance, mainly from a psychological point. We didn't quite get up to that point. I had also calculated R3, which we got about 10 points below that. We never got to R3. As the day went on, prices drifted sideways, so we didn't see a lot of selling into strength, and that can be encouraging. And we held on to those gains as things settled down, as the Fed was getting ready to do their thing. After they made their announcement, prices chopped around as they always did, but we didn't see any real definitive move in either direction. We stayed above R2, but we closed well off the high. And that's when I go in and look at the daily charts, I'll show you that this could potentially develop into something kind of scary looking, or it could be a non-event. We were up 0.85% on above average volume. And we are positive in the short, intermediate, and long term. We're still seeing these negative divergences. We're just seeing a few of the stocks actually participating and shooting the market higher. And then it's about inflation and interest rates. The market really liked the CPI report. Now we're going to get PPI on Thursday, so we'll have to see how that goes. And then all the different geopolitical things. And the things that he's talking about, Bob Kindle, in the video, that's why I watch all these things. Everything going on around the world, things going on in Russia, things going on in the Middle East, things going on in China, because these things could eventually develop into something kind of big and actually have an impact on the markets. Some comments, and there's kind of a long list here. The S&P, the NASDAQ, and the NASDAQ 100 did set new all-time highs again on Wednesday. The Fed ended up leaving rates unchanged. That was not a surprise. We had pretty much expected that. But when they came out with their little statement, they call it a directive, said that the committee does not expect it will be appropriate to reduce the target range until it has greater confidence that inflation is moving substantially towards 2%. This is what they've been saying all along. And this is the higher for longer scenario. And then they come out with their report, which kind of has become a big deal. The Summary of Economic Projections, or SEP. It showed the median estimate of only one rate cut. Now, the last time we had this report, they showed that there could be 3 rate cuts. The market could have just tanked on this news. What? Only 1 rate cut? We want 3. The beginning of the year, they were looking at 6. So things have really cut back. And this will change as we go forward as well. And then during the press conference, Fed Chair Powell was non-committal about where we're going to do with policy. We're going to raise rates, lower rates. He really ended up giving non-answers during the press conference. The mega caps had a really solid day, and that's really what's leading the market higher. The negative divergences that we're seeing, they're becoming more pronounced, as I've been pointing out. And even after the upward move on Wednesday, they're not really going away at this point. On a short-term basis, we have our pretty much our complete list now. Now, there's two ways to take this, that we're extended to the upside and due for a pullback, or that this is showing good shorter-term momentum. The Stochc RSI, the Williams percent R, CCI 14 and 20, stochastics in the RSI based on 9 periods. Intermediate term, seeing the list getting a little bit longer here. The CMB composite, which I didn't add before yesterday's video. The standard deviations chart, we're up into the +3 channel. The Erin indicator is looking pretty extreme, pegged near the top. The Sean trend meter had ticked down, now it's gone back up. The Chaikin oscillator and the ultimate oscillator as well. The percent B, and I'll show you this on the chart. This is based on Bollinger Bands. We closed outside of the upper Bollinger Band, and then the RSI based on 14 periods. That's a new addition as well. We'd seen the RSI 9, that's shorter term. Now the 14 period is looking extreme. The current scenario, and this is changed just a little bit, that they're keeping rates higher for longer, as I've already addressed. If there's a rate cut, it's still looking like it might be September, and they're seeing one cut rather than 3. And now we're wondering, okay, there seemed to be this idea that they were worried about the economy showing signs of really slowing down. That kind of seems to be going away a little bit. The dollar was down and interest rates were down. This gave support to stocks. We dropped from 4.4% on the 10-year yield after Tuesday to 4.3% after Wednesday. So that really helped stocks. We're still inverted with the yield curves. We only ticked up a little bit. We're still neutral with sentiment, according to what we look at 47, where it had been at 46. Now, we are starting to develop a trend, and that is a positive trend, but it's a non-confirmed trend. And I'll explain that when I get to the chart. But the green line's on top. The ADX is above its moving average, so that's showing that we're trending, but we haven't crossed above 20. That's the confirmation that we're looking for. We're positive with the bias, and we're positive with the momentum. Economic reports, the weekly MBA mortgage applications index really saw a nice advance here at 15.6%, where last week it was down 5.2%. Here's the CPI, the headline number. It came in unchanged. They expected it to be up 0.1%. Last time it was up 0.3%. The core CPI, this is what the market pays attention to for inflation. It actually came in lower than expected. They thought it was going to come in up 0.3%. It came in up 0.2%. Last time it was up 0.3%. Here is a chart looking at the mortgage applications. A really nice advance after we had seen a couple of weeks of declines. Here's the year-over-year CPI. The blue line is the total, and that's going down. The core, that's where the inflation component is. That's also declining, and the market really liked that. When you look at services and commodities year over year, we're seeing a real decline here when we look at the core commodities, and that just shows there's not a lot of inflationary pressures right now. And we're even declining a bit when you look at the services and take out energy. Here is our chart just showing the year-over-year change, where we are declining with the headline CPI. Month over month, we really took a real downturn here. The core CPI also showing a decline year-over-year as well as month over month. Some Isabel Net blog charts. This just plots the ISM manufacturing and then the non-manufacturing, what you could call services. The red line are services, and that's why they've been doing a little bit better. The blue line here is the 50 level. When we're above 50, that shows expansion. Below 50 shows a contraction. And we are seeing a bit of a contraction lately when we look at manufacturing. This is some of the economic weakness that the market is a little bit concerned about. But on a services side, they're not as concerned because we're actually going up. Now, remember the history of the U.S. We started out as an agricultural type of society where most people lived on farms, and then we developed into an industrial society where people started working in factories. Now we're going through the part where we're switching from being more industrial, where we make things, to service-oriented type of things, and that's why you see the red line above the black line. The buybacks, latest chart that we have here does show it going up recently. Just companies are doing a lot of buybacks right now. And the breadth index from Goldman Sachs, it's really dropping off. Now, this was before Wednesday's session, but that's one of the concerns and one of the things that we're a little bit worried about as we go through our charts that I'll go through later on. Then volatility tends to start rising around 1 month before election day. Well, I don't know why they showed this because we're quite a ways away from the election day, but and that's kind of to be expected a little bit. They don't know who's going to win. They don't know what's going to happen. The markets don't care really if it's a Republican or a Democrat. Back in 2016, there was an 80% chance the day before the election that Hillary Clinton was going to win, and Donald Trump ended up winning. And the market, I mean, most of the action took place in the after hours, and it was fun to watch. It was like watching a football game or a baseball game. But by the time we opened the next day, the market had readjusted itself. And it's not that it was negatively reacting to anything, it was just adjusting to new realities. The people on Wall Street, they've got friends on both sides. What they do like is when Congress is split between Republican and Democrat, because then that means rules are what Wall Street doesn't really like. And when there's a split, there tends to be fewer rules or regulations that are passed. But it's common to see volatility pick up, and then after the election, it calming back down. And looking at oil, where we're seeing a lot of folks getting out of that now. Many thought that it was going to continue to go higher. As it started to come back down into the low 70s, it is seeing a lot of people getting out of that. And then this is what we're seeing as far as inflows. Most of the money is going back into tech and communication. These are growth areas. One thing that we would like to see is discretionary doing better. There's some money coming back in, but it's not showing an awful lot of money. And the defensive areas, staples, especially even materials and industrials to a degree, we're seeing money going out of that. We're also seeing money that has been coming out of healthcare, and utilities are pretty much flat right now. These bottom areas tend to be more defensive. So possibly, just possibly, the market is trying to switch back over more offensively. That's more the buy low, sell high growth type of thing. But we need to see more than just what we're seeing on this chart. And then risky versus safe asset. Folks are getting a little nervous and starting to get out of their risky assets and actually preferring to get more into the safe assets. This is the projection before we had the CPI come out from Deutsche Bank, where, well, they have a line here, but actually we're into 2024. The takeaway from this is that they're forecasting both the headline PCE and core PCE as well as the CPI and core CPI to decline. And the market likes that. Oh, I see. They have a line here because of no, that's this line. I don't know why the black line is in there because that's not where we're at right now. All right. Didn't find anything on Twitter. Lots being said, but nothing's really that I could find of real substance there. So looking at our intraday chart, they like the CPI report. The futures just shot up higher. That produced a gap higher open above R2. We never got up to 54.50. And as I said, R3 was even above that, and we didn't hit that level. But we held on to a lot of these gains. Here's the choppiness that we saw as things were working themselves out after the Fed made their announcement. We did see a pretty decent sell program come in, but then we closed up off of that, and we closed above R2, but we also closed well off of the highs. Looking at the 10-minute chart, not an awful lot. The takeaway here is this is when the report came out and how the future shot up, and that bled over into the cash session. We did see some pullback during, and I think the NASDAQ futures are actually quite positive now, but we're going to have PPI coming out, and that can have an influence on things. Looking at growth versus value intraday, this is still looking quite positive. The blue line's above the red line. And when we look at the growth to value ratio for the S&P, it's off of its highs. But going back to the beginning of June, we've been seeing this on an intraday basis showing some improvement. End of day, we were up. We were up over 2% at one point, 2.5%, I believe. So we were well off the highs with growth, where value was actually down. We were up more with the mid caps and with the small caps. So looking at our value growth to value ratios, the small caps are showing an improvement. The mid caps, after seeing a death cross here with this ratio, they are improving. And the S&P showing a little bit more strength here, finally starting to break out above these previous highs. That could be positive if we see more follow through there. The ratio from the different ETFs, we're continuing to go up there. So that's looking more positive. Discretionary, it showed a little bit of an uptick here, and we actually saw staples going down, which is helping the ratio between the two show an improvement, but we haven't broken out above these previous highs, at least yet. Large cap growth looking pretty solid now. The Wilshire closed well off of its high, but up on the day. Here's the look at the trend where we're starting to cross back above the moving average. The black line, which is the ADX, and then I plot the moving average on here, we're turning back up. So that suggests a trend is starting. When it crosses back above 20, that will mean it's a confirmed trend. And then whatever line is on top, that's what we go with. The green line is on top and advancing, so that would be a positive trend. We're seeing a very similar thing here with the short term. Above the moving average, just a little bit below 20, green line on top and advancing. We did see for 3 days now, we've seen a real pickup in volume. And here's sentiment. We're actually going down a bit with the Ulcer Index. We got the latest reading from Investors Intelligence. They came in at 3.43, so they're still looking rather bullish. We did decline with the VIX on a closing basis when we look at the bar chart, the line chart, and we also closed pretty much near the low with the bar chart. Volatility VIX, man, it was kind of all around on an intraday basis here. And we're also dropping off as we saw the upward move. So volatility has been going down. The MACD is just about crossing over below its moving average. So the momentum could be getting ready to switch from going up to actually going down. We did decline with the equity put call ratio on the daily chart. We're declining with the 5-day chart. That's positive. We're coming down, but still above the band here with the volatility risk premium. We declined with this fear gauge, but we actually ticked up again with this fear gauge. And these aren't pure fear gauges that we look at. They're just proxies that we can use to try to get an idea. So sometimes when we see a discrepancy between them, it's not a real big deal to me. This is where we are seeing some problems here. We're setting all-time highs. We gapped higher with the S&P, and we're not really turning up based on price when we look at the advanced decline line. We're holding up much better based on volume, but we're just kind of treading sideways right now. We did see an expansion of the new highs as we're breaking out to all-time highs with the S&P. So we're turning back up with the 5-period and the 10-period. So this internal measure is looking stronger. And we're still kind of straddling the line here. We're negative with the shorter term advanced decline ratio. We're still slightly positive with the intermediate term advanced decline ratio. This is a concern. This has been an area that has been really giving us something positive to hang on to see the upward move that we've seen and to see accumulation distribution actually drop off. Just something to watch. We haven't turned negative. We just turned down where you might have thought that this should have gone up. We're seeing that also confirmed by the chicken money flow. It declined on a pretty solid up day, and now the red line is starting to turn over. Hasn't turned negative, and this could always change. Just something that we want to be aware of right now. We're also seeing the Chaikin oscillator ticking down just a little bit, but it's still positive as well. When we look at our cumulative NYSE advanced decline line, just the big up day that we saw, and this just ticked up a little bit. We look at the regular advanced decline line, not really much of an improvement. Not much of an improvement with this other NYSE advanced decline line. We're still seeing where volume is doing okay here. We have common stock on the NYSE based on price, a bit of a tick up. Actually, this kind of underperformed here. We barely ticked up based on volume. And when we look at the S&P cumulative advanced decline line, it really didn't move. And it's still hanging in there and looking more positive when we look at this based on volume. We're just kind of chopping sideways below this previous high based on price, where we've exceeded the previous high based on volume. Looking at our advanced decline line studies, yeah, we saw some improvement. We're turning back up to the moving average with the NYSE common stock, a little bit under the moving average with the S&P, turning up but still below the moving average with the mid caps and the small caps. I think I got that wrong. Anyway, back up to the moving average, above the moving average, under the moving average, under the moving average. Okay. I changed the labels on here recently, and for some reason it's not. Maybe I need to move these words up a little bit. Looking at the daily chart where we got above this pivot point, and that was the low that we set as well. So this may be providing support, at least for right now. We've seen 3 days now with above average volume. And with our short-term indicators, we are extreme with the Stochh RSI, the Williams percent R, CCI 14 and 20. We're looking extreme with all of our stochastics charts. Looking at our 20-period double and triple exponential moving average, we're well above based on price, and the lines are going up. So that's positive in the short term. And then the 20-period, I mean, to set an all-time high, I mean, we're seeing kind of a negative divergence here. The S&P's been hitting all-time highs, but we're not setting highs here with the 20, 50, or 200, even though they both ticked up slightly. The force index is positive and not necessarily extreme right now. We're above the 20-period moving averages when we look at the simple and exponential versions of the moving averages. We're getting up into the +3 channel with our standard deviations chart. That could be extreme positive, but we can stay up here when we're showing good momentum. We camped up in here back in May for a number of days. The boom indicator, haven't shown this in a while. We're starting to look extreme. We're getting a little far away from that 20-period moving average. So we use this like an oscillator to show that price is a little far away from that moving average and sometimes has a tendency to snap back. We're looking more positive with the 50, but not extreme. Also looking positive with the 200. The balance of power above zero, ticking up, but not showing an awful lot of conviction, but it's still positive. We're still positive with the go, no-go system with the darker blue bars. Positive with the highest high value. This is encouraging. We're seeing the TTM squeeze starting to turn back up, and it's changing to a lighter shade of blue. That's more positive there. Looking at our double and triple exponential moving averages based on 50 periods, we continue to be above both lines. The longer we can stay above this, the more chance the red line may cross above the blue line, which shows more intermediate term momentum. Here's the CMB composite, which is extreme positive. Ease of movement is positive. We're coming down just a little bit after being extreme with the Arun, but it's still giving us a pretty high reading. The green area, that's buyers. The red, that's sellers. We saw a bit of a turn up in the sellers. That's why we saw the oscillator decline on the bottom. And we're not seeing much of an improvement here. This is the S&P McClellan oscillator. It ticked up, but it's still below zero. So that's negative. So we're seeing quite a negative divergence here. When we look at the summation index based on price, we're hitting all-time highs. We were going up while the summation index has been going down. Also, it's going down based on volume. NYSE McClellan oscillator ticked up, but still below zero. So we're declining with the summation index for the NYSE based on price and volume. Those haven't changed. We're getting even a little bit more negative with the Swenlin trading oscillator. We're declining further below zero based on price. We're coming just down to the zero line. We're at 0.03 right now. So we're holding up a little bit better with volume, but not much. But on a momentum basis, our oscillators are starting to turn back positive when you look at the PMO, but we're still negative when you break them out based on price and volume. We're going back up with the PMOs that are rising. We're trying to turn back up with the buy signals and still declining to flat with the PMOs above zero. Not the big improvement that you would necessarily expect. But when you look at the trend of everything, we are positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. The slope oscillator is turning back up and coming right up to its moving average. The MACD is back above its moving average. So in the short term, we're turning back more positive. Intermediate term, we're looking more positive. Trying to turn up a little bit here with the tricks, and we're still on top of the moving average with the KST. Above all the plotted moving averages. So when you measure things based on moving averages, which is a primary indicator, this is positive. It's just when we look internally at what's going on, that's when we start to see some signs of concern. Bullish percent index did tick back up after it had been declining. It's still positive, but we would like to see this doing a lot better. This just means that even though we're setting all-time highs, there's not a lot of new point and figure buy signals being generated of those stocks inside the S&P. We did tick up and we're positive with the NYSE bullish percent index. Now, this is encouraging. We're crossing back above 50 with the NASDAQ 100 bullish percent index after it had been negative. So this negative divergence, at least for right now, appears to be going away. The money flow is positive and not necessarily extreme yet. The ultimate oscillator is extreme, but that's positive. The vortex shows the green line going up and the red line going down. That's positive. We're starting to get extreme with the RSI 14, and now we've been extreme for a couple of days with the RSI 9. On balance volume is positive, and the stocks above their 20-period moving averages were ticking up, but we have not been able to get back to 20. So when you look at the moving averages of the indexes, yeah, we're looking great. But when you look at the stocks inside of the S&P with their 20-period moving averages, not so much. So we're wondering if we're going to see more of an improvement here with our 20-period study. And we're still below 50 with those stocks above their 50-day moving average. We did tick up, but that's negative, and that's more intermediate term. We did turn back to positive with the 100. We had crossed below 50. Now we were able to tick back above that. And we turned up slightly with those stocks above their 200-day moving averages. The copy curve is still negative, but could be getting ready to cross over. This is another momentum oscillator. The Sean trend meter is getting extreme positive. And I've been showing the standard deviations chart. We're getting a little bit further above the moving average here. That just means that we're moving pretty fast because standard deviation doesn't measure direction. It just measures speed. And we're picking up speed these days. Here's the percent B indicator. We closed outside of the upper Bollinger Band. So that's why we're getting an extreme reading. And we tend to not see these readings very often. And when we do see them, they tend to not last very long. I think this one back here lasted about 3 days or something. So yeah, they can go on for a while, as far as 2, 3, 4 days, something like that. But then once it's over, we tend not to see one for a while. This is turning a little bit more positive with the Amex, NASDAQ, and NYSE and taking a 5-period moving average of the highs minus the lows. We were just starting to drop below zero. Well, on Wednesday, we were able to tick back above zero. Do have it now. Remember this chart? Support and resistance here. I thought I was done with this chart for a while because we were battling through this R1 chart or R1 pivot point. This is a monthly chart of the S&P. And we were really battling this R1 level. Well, now look at what we're battling next. We're coming right up to this R2 level. Is this going to provide some kind of overhead resistance here? And this is at about the 54, 51 level. So right around that 54.50 level, we'll see if that ends up becoming something. But on a trending basis, even our different charts are still looking positive with the Heiken Ashi, the Kegi, the Renko, the 3-line break, and we even had a new X drawn in here with the point and figure chart. We had enough of an up move to draw in a green X. We're still working off of the signal that was generated on May 15th of a double top breakout. Long term, we are going back up, but not looking extreme with our 150 and 200 period moving averages. We have not seen a confirmation, at least yet, with the Hindenburg Almond. And we're only looking negative with the mid caps in the short term. And that's a little bit of a concern. We're just not seeing an awful lot of strength there right now. And bonds are still looking okay in the short and intermediate term based on price. They're still negative in the long term, where commodities and the dollar are negative in the short term. No changes with the decision point scorecard. Awful lot of signals that were generated when we gapped higher, because we read this from the bottom up. We got all kinds of really wonderful, amazing things happening. And then the dollar crossing below 105, they see that as negative. That actually helps stocks. We saw staples showing some weakness. The financial sector is under a little bit of stress right now. We're setting a 4-year high with the S&P, the NASDAQ setting a 4-year high. The NASDAQ just going to the moon here above 17.2 and 17.3. Ride 'em, cowboy. And the sectors that you would expect to do well on a good growth day did well. We had tech, discretionary doing the best. The one lagger here was communication. Would have been nice to see that one do better. It was down slightly. And the defensive areas, staples, to a degree, energy and utilities, those were the ones that were down a bit more. We are looking better here with the new highs minus the new lows for the NYSE. We were starting to cross above zero. Now we're starting to go back above zero. The equal weight, we're just really outperforming. These are the big stocks that are really controlling things. This means that the large caps are really outperforming the rest of the market as measured against the S&P 500 equal weight index. The Dow ended up actually being down. It was first to go negative later in the day and ended up being down just slightly, coming right back down to its 50-day moving average. And we're still neutral with the Dow when looking at the Elder's Impulse system. We broke above this R1 level. This had been possibly acting as overhead resistance. We gapped above that. Now, if we do come back down and try to fill this gap, which sometimes will happen, we'll be wondering if this R1 level will provide support. We're seeing that same thing here. We gapped above this R1 level with the NASDAQ 100. If we come down, will this area be providing support? We are positive with the Elder's Impulse system when looking at the Qs. We're positive on a momentum basis with the NASDAQ 100. The small caps had a pretty good day, but aren't really breaking out right now. They're still below this pivot point here. But they've switched over to positive after being negative with the Elder's Impulse system when looking at the small caps. Here's the other small caps as measured by the Russell 2000, crossing slightly back above 50 with the RSI. We got back above the 50-day moving average. And this is kind of scary to close down near the bottom here. And the momentum still continues to be negative. The mid caps, again, closed near their bottom, right about at their 50-day moving average and slightly below this pivot point. We're not seeing an awful lot of strength here currently. And the mid caps, though, are positive after being negative with the Elder's Impulse system. Apple just continues to go up. It's kind of the new darling stock for the present time, but even it closed well off of its high. Tesla was up 3.88% and just getting back above its 50-day moving average. Nvidia was up 3.55%, setting a new all-time high. Microsoft had a good day, setting an all-time high. Meta, not an all-time high, but was up 0.25%. Amazon was actually down a little bit, but still above its 50-day. Google was up 0.2% and above its 50-day moving average. And Netflix was up 0.25%. You see, even some of these big companies aren't really participating. The FANG index did set a new all-time high, although it did close off of its high. Financial sector, seeing a little bit of weakness here as we're dropping slightly under the 50-day moving average. The staples to tech ratio really declined, and that's what we want to see in a more positive environment. The dollar ended up being down, even though it shows a plus here. This is after hours, but it's in an uptrend, at least for the moment. The correlation between the S&P and world stocks that we look at is really falling off in the short term. A little bit of a decline here with the longer term correlation. The staple sector was down over 1%, but still above its 50-day moving average. Utilities also down over 0.5%, but still above their 50-day moving average. Healthcare was down after it had been giving a nice run as of late. Energy was down over 1% and still below its 50-day moving average. Looking at the total U.S. stock ETF, setting an all-time high. We were down with the 10-year yield. That really helped stocks, and we were up with the 10-year based on price. But even this, you can see we closed pretty much at the low, where we also closed at the low here based on price. And it's like, okay, we need to see more follow through. But when we look at this soft landing versus hard landing scenario, it's just continuing to go up. Here's an inverse of that same thing. This ratio continues to go down, showing bonds are underperforming. Look at the S&P 1500 and compare it with shorter term bonds. We continue to break out. Another broad market measure is also breaking out compared to 3 to 7 year bonds. This is still holding up quite well. The Qs are holding up well when compared to 3 to 7 year bonds. The tech sector is breaking out compared to 3 to 7 year bonds. Looking at our growth to value ratios, the Qs to S&P, yeah, this is looking pretty good. But look how discretionary is not really looking all that good. large cap growth is outperforming large cap value. So we're looking better with large caps, bit of an improvement with the mid caps and the small caps. We want to stay above this and see the moving averages turn back up for the mid caps and small caps. We're still below the midpoint with our advanced decline line based on 19 days. I'm sorry, the advanced decline ratio. We're below zero based on price. We're above zero based on volume. The S&P to utilities ratio continues to go up. That will be more positive for the S&P if it can continue. The Staples to S&P 500 ratio is going down. That will also be positive for the S&P if that continues. So what's our outlook? The technicals are positive, and there is strength coming in here, but these negative divergences are not really going away. There are some improvements, but some pretty critical things still are not flashing that everything is wonderful right now. We're going to get the weekly jobless claims and existing claims, and then the PPI will be a big report that comes out, keeping an eye on all the crazy stuff going on in the world in case it does really impact the markets in some way. Then on Friday, we're going to get consumer sentiment. There's going to be a 30-year bond auction on Thursday too, which sometimes may have an impact. Seasonally, we're back to neutral to positive when we look at June 13th for the Dow, S&P, and NASDAQ. Thursday is one of the more better looking days compared to how we did in 2023. We are potentially coming into a few days of positive seasonality. We saw this downward move, and now we might start to bounce up here going until about the 21st, first day of summer. Isn't that kind of cool? About when we get up to options expiration. So we might see a little bit of an improvement along the way. No guarantees here, but at the same time, this is historically what has happened and can serve as a guide. June tends to be, well, according to Carson, also July and August are typically positive. I'm probably going to shoot this over to the weekly video here pretty quick. And then we're coming back into the positive time now with Tom Bowley's research. So this is the positive seasonality that we're seeing on other charts as well. The staples and utilities, they have been strong lately, and they're not necessarily turning and going negative. If anything, it looks more like profit taking. We still just want to be aware of that. And we're also keeping an eye on energy and healthcare. The advanced decline lines are not really showing a lot of robust improvement, but robust strength, but they are improving. And the growth to value and discretionary to staples, yeah, they're looking a lot better, and they had a good day on Wednesday. Can they follow through with any more? And the McClellan oscillators and summation indexes for the S&P and NYSE, they're still negative. And to me, that's a big, big warning sign. The Swenlin trading oscillator is still in the process of turning negative. It already has based on price. It's not quite there based on volume. The copy curve is negative, but it could be getting ready to turn back up. And the 20 and 50 moving average studies, the 100 got taken care of, but we're still looking negative with the shorter term moving average studies. And then looking at our equity put call ratio based on 5 periods, it is going down, and that's positive. The parabolic SAR is positive, and then we take the three together, the smart money indicators, accumulation distribution, a little bit of a turn down there, but still positive. Chaikin money flow, a little bit of a turn down there, but positive. And the Chaikin oscillator, also a little bit of a turn down there on a solid update, but still positive. Our oscillators are turning back over positive. Looking better in the short and intermediate term, not necessarily confirmed yet in the long term. The bullish percent index is now bouncing back up, and it was still above 50. So that's positive. The money flow, the ultimate oscillator, the vortex, the financial sector is positive, even though it was under a bit of weakness on Wednesday. And the momentum for the NASDAQ 100 is positive. And the bullish percent index, we've crossed back above 50 for the NASDAQ 100. So that is also positive. So our conclusion, we are now positive. We're seeing some real areas of strength, and that's helping the indexes. But there's these negative divergences. They're still there. In the short term, we are looking overbought. That's how you could take it one way. Is that showing good momentum on the other hand? Intermediate term, we are improving, but there's these negative divergences. And most of them that I'm seeing are in the intermediate term, where we continue to be positive in the long term. Thank you. I really hope you found this helpful. Have a wonderful day, and I will talk to you in the next video.